My portfolio Sharpe ratio was 1.6, and according to the standard interpretation, that's a strong number. More than twice Berkshire Hathaway's Sharpe over 40 years from 1976 to 2017. More than 3 times the S&P 500's long-term Sharpe over the same period. And yet, when I look at that number on my dashboard, I don't feel good about it. Because I know what the Sharpe ratio actually measures, and I know what it doesn't. In this video, I'm going to talk you through 3 numbers, Sharpe, Sortino, and the Calmar, and explain what each one tells you and what each one hides, and why the way most retail investors use the Sharpe ratio is closer to financial astrology than mathematics. If you've ever ranked a strategy by Sharpe ratio alone, you should probably watch all of this video. Before we get into the math, here's why it should matter to you. Imagine you have 2 different funds. Both return exactly 12% per year over the last 5 years. Identical numbers on paper, but one of them got there with a smooth, steady ride. Small gains most months, never any serious drawdown. But the other got there by dropping 35% in the first year and rocketing 60% the following year. The same number, but a widely different experience. The first fund you could have held without thinking about it. The second one, you'd have spent half of the year wondering whether to pull your money or not. Returns alone never tell you which is a better investment. They don't tell you which fund was a better strategy. The path matters as much as the destination, and in retail investing, the path is the thing that determines whether you'll actually stay in the fund long enough to capture the return at all. Risk-adjusted return is the maths that tries to quantify the path. The Sharpe, Sortino, and the Calmar are 3 different attempts at it. Each one tells you something the return number can't. Each one has flaws, and each one is worth understanding before you put your money behind a strategy that quotes returns without quoting the risk. So 3 concepts up front because everything else depends on them. First, the difference between volatility and risk. Volatility is how much the asset's price moves around the average. Risk is the potential for permanent loss of capital. They get conflated constantly, but they really shouldn't because they're different things. The second concept is risk-adjusted return. What we just talked about is the umbrella all of today's metrics fall under. And third, every metric we're about to discuss is calculated from past data. They describe what's already happened and they don't predict what's coming next. Remember that history rhymes, but it never repeats. So the volatility versus the risk distinction is the most important concept in this video. So I'll spend a minute talking about it. Volatility is the spread of returns around the mean. It's the daily wiggle. It's the standard deviation of the equity curve. And this part matters. It's symmetrical. A 10% jump up is treated by volatility maths the same way as a 10% drop down. Both increase the calculated volatility number by the same amount. Risk is something different. Risk is the probability that your capital takes a hit that you can't recover from in the time frame that matters to you. A tech stock might move 5% every day and still be a fine long-term investment if it trends upwards. So the risk wasn't the daily movement. The risk would be a crash that takes its value to a permanent lower base that you can't stomach. The distinction sounds academic. It's the entire reason Sharpe ratio is a worse measure of risk than its reputation would suggest. The Sharpe ratio was invented in 1966 by William Sharpe, who later won a Nobel Prize for related work. The original name was the reward to variability ratio, which is, incidentally, a more honest name than the one that stuck. The calculation is straightforward. You take the return of your portfolio, subtract the risk-free rate, and divide by the standard deviation of returns. The numerator is the excess return, what you earned above just buying treasury bills. The denominator is the total volatility. The ratio is supposed to tell you how much extra return you earned per unit of risk. The classic example is Berkshire Hathaway. From 1976 to 2017, Buffett's Sharpe was around 0.79. The S&P 500 over the same period was around 0.49. So according to Sharpe, Berkshire delivered roughly 60% more return per unit of volatility than owning the index. Buffett ran a higher Sharpe portfolio than the market for 4 decades, which is extraordinary. So what's the problem? The problem is the denominator. Sharpe uses standard deviation, which measures total volatility. It treats upside movement and downside movement identically. A great month, say a 15% gain, increases your standard deviation, and so does a terrible month, a 15% loss. From Sharpe's perspective, they're equally risky, but investors don't experience them that way. A 15% loss is what keeps people up at night. A 15% gain is what they got into the market for in the first place. Sharpe ratio penalizes both, and this is the flaw which critics return to constantly. A fund with a huge winning month gets a worse Sharpe than a fund with consistent mediocre returns. The strategy that delivers occasional home runs gets dragged down for delivering them. The math literally calls upside volatility a form of risk, when no actual investor sees it that way. And there are other issues. Sharpe assumes returns are normally distributed. They follow a Gaussian bell curve. They don't. Real market returns are fat-tailed. Extreme events happen more often than a normal distribution would predict. Sharpe doesn't capture this. Sharpe can be gamed. If your strategy holds illiquid assets that you price using internal models rather than market prices, you can smooth your reported volatility and make your Sharpe ratio look much better than reality actually warrants. And some hedge funds have built entire reputations on Sharpe numbers that turned out to be artifacts of accounting choices. And maybe the strangest issue, Sharpe is time dependent. An annualized Sharpe calculated from daily returns is mathematically much higher than the one calculated from annual returns on the same portfolio. So when someone says their strategy has a Sharpe of 2, you don't actually know what that means unless you know how it's being calculated. Most of the eye-catching Sharpe numbers you see online are annualized from daily or weekly data, and they make portfolios look much better than they actually are. And this is where the Sortino enters the picture. Frank Sortino developed his ratio specifically to fix Sharpe's biggest flaw, the symmetrical treatment of volatility. The Sortino ratio uses the same numerator, excess return above a target, but the denominator is calculated using only downside. Specifically, it measures downside deviation. For every period where your return is below your target, you record how far below and square it. For every period where you met or beat your target, the deviation is recorded as 0. You average the squared deviations across all periods, including the zeros, and take the square root. That last detail really matters because the common mistake is to calculate downside deviation using only the losing periods, ignoring the winning ones, and that's wrong. You have to include the winners as zeros in the average because the frequency of falling short matters as much as the size. A strategy that falls below target 50% of the time is genuinely riskier than one that falls below 10% of the time, even if the size of the typical shortfall is identical. Sortino gives you a number that reflects what most investors actually care about, the magnitude and the frequency of underperformance against the target they chose. If your target is the risk-free rate, Sortino tells you about the losses. If your target is 6%, because that's what you need to retire on time, Sortino tells you about the risk of missing your retirement goal. My portfolio Sortino is about 2.5. That's a theoretical relationship when returns are normally distributed and the target equals the average, where Sortino is mathematically Sharpe times the square root of 2. So a Sharpe at 1.6 would imply a Sortino of 2.29, and mine is 2.5, and that number is slightly higher than the theoretical relationship predicts, which tells me that my returns are positively skewed, but roughly symmetrical around the mean. So the 5 strategies I run as a collective portfolio are designed to deliver smooth compound growth, and the Sortino ratio reflects exactly that. Just rules executed consistently across uncorrelated systems. That same gap, when it's much wider, can also flag something dangerous. A strategy with consistent small wins and rare catastrophic losses, think uncovered option selling or carry trades, looks great on Sortino until disaster hits, and once it does, Sortino corrects sharply. The ARK Innovation ETF is a great example of this. In early 2021, just before its collapse, ARK's Sharpe and Sortino ratios were both the envy of the industry. Both turned out to be artifacts of an exceptional bull run rather than a real measure of structural quality. So Sortino is a meaningful improvement on Sharpe, but it still smooths the experience of risk in a way that doesn't match what holding a portfolio actually feels like. What scares most investors isn't downside deviation or standard deviation, it's the biggest single drawdown which you had to live through. So that's what Calmar ratio measures. Calmar takes the compound annual growth rate of your portfolio and divides it by the maximum drawdown. That's the largest peak to trough decline in a portfolio's history. The output answers a brutally simple question: how much annual return are you getting for every percentage point of maximum drawdown you have to endure? Its strength is that it speaks directly to the question most investors ask in private: how much pain am I being paid for? Its weakness is that it depends on a single data point. The maximum drawdown is one number drawn from one specific moment in a portfolio's history. If your measurement window happens to miss the worst stress test the strategy has ever seen, Calmar looks deceptively good. If the window happened to catch a once-in-a-decade event, Calmar looks deceptionally bad. And this is why this particular ratio is most meaningful over a long time horizon in a backtest that spans full market cycles. A Calmar over 5 quiet years can tell you very little. A Calmar over 50 years worth of data that took you through the 2000 bubble and 2008 crash will tell you something different. The most useful framing I've seen is to read the Sortino and the Calmar together. Sortino tells you about the typical experience of falling short of a target, frequency and magnitude. Calmar tells you about the worst case. Together they describe both the everyday discomfort and the catastrophic risk you'd be signing up for. So how do I actually use these in my own portfolio? I don't use any single one as a decision input. I use them together and I treat them as forensic. They help me understand what kind of portfolio I'm running, not whether it's good or bad. The Sharpe of 1.62 tells me that my returns per unit of total volatility look strong. A Sharpe above 1.5 on a live, real money, multi-year track record is genuinely uncommon. But I still don't lean on this number on its own because I know it understates the portfolio's downside behavior, and I know it would penalize me for any unusually strong month. So a Sortino ratio of 2.5. This is the number that more accurately reflects what holding the portfolio actually feels like. Slightly higher than the Sharpe times square root of 2 baseline, which tells me my returns are positively skewed. The systems are doing what they were designed to do, smoothish compound growth. And Calmar at 1.44. This is the brutally simple one. Calmar above 1 means that I've earned more annual return than my worst peak to trough drawdown. 1.44 means I'm earning roughly 44% more annual return than my worst pain point cost me. That's a structural read on the portfolio's risk discipline. If Calmar deteriorated sharply, if a new maximum drawdown set in faster than the annual return could absorb, I know something about the portfolio's structural risk had changed. Even if the Sharpe and the Sortino hadn't moved yet, the real lesson is that none of these numbers on their own tell you anything decision grade. You don't pick a strategy because it has a Sharpe of 1.62 or a Calmar of 1.44. You pick a strategy because the rules make sense. The backtest shows positive expectancy after costs. The system holds up under regime change, and the risk-adjusted numbers across multiple metrics are consistent with the philosophy. Risk-adjusted return is one of those concepts that's easy to talk about but hard to measure in reality. Each of the 3 ratios I've just walked through gets a different slice of it. Sharpe gives you the smoothest, oldest and most easily gamed measure. Sortino gives you more investor-aligned measurement but assumes that you can cleanly separate good volatility from bad. And Calmar gives you the most visceral measure, but it depends on a single historical data point. None of them are a forecast, none of them are a guarantee, and all of them are calculated and derived from past data. And past data is exactly the thing the next market cycle will not perfectly resemble. The number on the dashboard isn't a strategy. The strategy is the rules and the discipline to execute them. The number is just how to describe what those rules have done so far.